Hey, what's going on? Sorry for the long video last time. I'm going to make this one much shorter. Now, the Bank of Japan ended its what they called ultra-loose monetary policy, also known as quantitative easing, in early to mid 2006. And I think a little prematurely, and I'll show you this here. Kyoto News International Incorporated, copyright 2006, okay, may have been a little bit premature in calling this. I'm going to read it to you here, okay? You just take my word at it, or I'll show it to you if you really want to fucking pause it, alright, and take a look yourself. Go ahead. But I'm just going to read this to you. The financial markets showed calmness in responding to the long-awaited decision by the Bank of Japan to end its 5-year-old ultra-loose monetary policy Thursday, with many traders saying the move had been largely expected. Although many welcomed the central bank's decision as fresh evidence that Japan is beating stubborn deflation, they also said the markets will remain under the effects of Bank of Japan's zero interest rate policy. That's called ZIRP. Z-I-R-P. Zero interest rate policy. And it essentially means that the central bank is loaning money out to its primary dealer banks. Okay, those are the big banks. For free. Which isn't really lending, is it? Anyways, the ZIRP policy is designed to create an artificial amount of liquidity. We still haven't left. Yeah, I literally went from one to another. So I'm going to finish this in the next 3 minutes. An individual working for Bear Stearns, lol, said there was no panic in the stock and bond market. The markets digested this event without difficulty. Now, I'm going to show you something interesting here, okay? We're just going to jump right to this. Now, this here is a monthly chart of the S&P 500. Now, I'm going to zoom in real close here. I'm sorry it's all like, grainy and shit. But do you see? Let me try and hold this dead still and see if this correctly focuses. Okay, who cares? Do you see this little green bar here? Very small, tiny little wicks on it. Guess what month that is? If you guessed March 2006, if you guessed that tiny little green blip next to that large red bar was March 2006. You guessed right. Guess what comes after March? April. That's that giant red bar. And guess what? Guess what comes after that? The continued wick down here. That's May. Then there's June. And by the time we hit July, we start rising again. But I want to point out to you that QE was ended here. And you can see that yourself. That says 3/31/2006. Right? And these bars are monthly, so they close at the end of the month. So QE, in the first QE, the one that lasted from 2001 to 2006, performed by the Bank of Japan, ended in March of 2006, and the market also ended up collapsing in March to April. That's just a coincidence, though, right? Well, the Fed also ended its first quantitative easing, which led to, let's see, this particular pullback. QE1 led to this. QE2 led to this. All right? And we haven't had an end to QE since, and guess where we've gone? Let's get out of there. Oh, hold on. We got to keep going up here. Sorry, apparently we can't see the top just yet. Oh, okay. So, let's recap. The market pulls back when QE ends. Now, I know what you're thinking, though, So, the first time QE ended, it was pre-2008. That's why we didn't pull back so far. It was the Bank of Japan. It wasn't the Federal Reserve who was in control of the world's reserve currency. Understandable here, right? That's why we didn't pull back so far. We're post 2008. We're post that frickin' collapse. And whenever QE ends, you can see what happens. So now that we're up here, you pretty much see that if QE ends, the market's going to 1987. And I think it's fairly safe to actually assume that if QE continues, there will be market corrections, there will be pullbacks, but I don't think we're going to really see a pullback like we ever will see. If QE doesn't end, I don't think the market will ever come back. That's a bold statement. I realize that's a crazy statement. That's a bold statement. But I want to show you this chart one more time. Okay? The credit market started blowing up here, and the negative balance on people shorting the equity market did great. Okay? Once again, 2001 to 2002, boom. You hit here, and you get yourself a fantastic short. The whole thing. You get the whole frickin' thing. Okay? We go over here, and we get another one. Quantitative easing in Japan ends. Okay? Not that big of a deal. It's only Japan. It's not the world reserve currency. And the economy back in 2006 was not looking like dog shit. It happens again, and you actually are able to grab the exact top, and the market plummets the whole fucking way down. It happens again. Quantitative easing ends. Quantitative easing begins again, and the market rises. Okay? Quantitative easing ends, the market plummets. Okay? And we get another one of these instances where the negative balance actually goes to being a positive balance. Alright? Quantitative easing begins again, and the market begins rising. And we go from QE3 to QE forever. Theoretically, forever. And I'm already hearing people working at the fraudulent too-big-to-fail banks, speculating that QE may increase. Now, I know a lot of people are very bearish on the stock market right now, especially within the last 48 hours. A lot of individuals have been saying things like, the market is going to pull back and it's going to crash. We're going to expect a 40% crash. I think what the big problem is right now, okay, we're going to have pullbacks. It's going to chop up and down. It's not just going to be linear up. We're going to have pullbacks. So get used to it. But what they're having an issue with, okay, is that the market looks like it's going to try and become overbought here, okay? Which is a bad thing. It really truly is a bad thing, because what happens when a market becomes overbought is it will become oversold. So it's better to have something rise at a consistent and steady pace rather than form bubbles. So I think we're seeing a lot of people speculating, both due to market technicals and other such things, that we're going to have a pullback. And I think they're absolutely right. But I would not anticipate that pullback to last. If you want to keep your long stock positions, that's fine. Simply hedge them with some long volatility. The volatility is quite low. It's been quite low. Once again, my advocacy is to insure yourself with some OTM options. Please don't use the volatility ETFs. Don't use VXX. Don't use UVXY. If you can trade the volatility futures, I'd recommend that. I don't know why I'm telling you guys that. You know what? Nobody watches these videos anyways, and if you made it to the end of this video, good for you. So once again, here we are, September 2013 being reported. and we are back to these lows. I think Zero Hedge is trying to speculate that because we're back to these lows, it means we're going to come screaming back soon. But I'd like to point out to you that you know, what ended up cracking these markets was defaulting credit markets and the end of QE. Okay? And QE does not appear to be ending, and the credit markets do not appear to be cracking. I don't know about you, but I can't even get a fucking house loan. All right? All right, I literally seriously can't, because I don't have 2 years worth of IRS returns. So I can't even get a loan, right? I went to the bank. I was like, "Look, man, I will pay you guys out cash except for like the last $30,000." This was back when I wanted a house, right, in the United States. And I said, "I'm going to give you guys, you know, $140,000. The price of the house is $150,000. You know, just float me, you know, $10,000 over a 30-year loan. I'm going to pay you guys back by the end of the year. Please, you know, let me do this." And they said no. And at that point, I was just like, that's insane. Who turns down a who turns down a loan on a $150,000 house, okay, when it's only for $10,000? That's to me, that's crazy. That sounds outrageously crazy. So, a lot of people expect, so the other thing that could potentially, the other credit market asset that could blow up, okay, would be the student loan bubble. And if anybody can tell me a little bit more about that, I'd be very interested to hear about that. Nado? Nado? That's interesting. I think someone's downstairs. And I gotta go. We gotta go see this movie. It's going to be terrible, but I'm going to be drunk, so it won't be that bad. Yeah, I hope you guys learned something from this, and I hope you don't go like the rest of the bears did. Remember, hedge yourself with volatility, and remember that one of the best protections against inflation is to be long stocks. But remember that, you know, if the market does begin to pull back and I am wrong for the first time in a long period of time, do not be afraid of a stop loss. Do not be afraid to pull your money at a loss. Holding on to it is probably the worst thing you can do. But, like I said, you can hedge yourself with volatility. And, yeah, that's advice coming from a guy who doesn't get it wrong. Fuck Gregor. Peace.